Everybody, if you see, we have completed all the sums on present value. There is one sum which is pending on present value of annuity. Let us complete that sum and let us go to other concepts. Now, I hope this one sum was pending. What is that? Question number 22 was pending. So let's go ahead and let us complete this question number 22 and let us wipe out the discussion of annuity and other concepts also. He's telling a company borrows 10,000 on a condition to repay it with a compound interest at 5% per annum by annual installments of 1,000 each. The number of years by which the debt will clear. Okay, let's try to do. So how much did he borrow? He's telling loan. So obviously it is supposed to be present value because loan or borrowing, all these things, we call it as present value, right? Now, he is repaying every year 1,000. So A will be equal to 1,000. Rate of interest is 5%. So I will be equal to 0.05. So let's start, my dear friends. Question number 23. Question number 23. A is equal to 1,000. Nothing is said in the question. So present value of ordinary annuity is equal to 10,000. Rate of interest is equals to 5%. Is asking n number of years. So present value of ordinary annuity. We can do it in calculator also, but I don't recommend you to do it in the calculator. Let's apply the formula. A divided by I into 1 minus 1 divided by 1 plus I whole power n. I hope you remember we are having multiple formulas. For the first formula, future value of ordinary annuity divided by 1 plus I whole power n. Next formula, A into 1 plus I whole power n minus 1 divided by I into 1 plus I whole power n. Third formula, A by into 1 minus 1 divided by 1 plus I whole power n. Next formula we have done in the calculator, 1 divided by 1 plus I equal to symbol n times grand total into A will give you present value annuity factor. So 10,000 is equal to 1,000 whole divided by R is 5%. So I will be equal to 0.05 into 1 minus 1 divided by 1.05 whole power n. Now let us do cross multiplication. Let's see what we'll get. 10,000 into 0.05 divided by 1,000 is equal to 1 minus 1 divided by 1.05 whole power n. I hope some cancellations can be done. Yes, sir. These three zeros get cancelled. So 10 into 0.05 will be 0.5 is equal to 1 minus 1 divided by 1.05 whole power n. Let us take this value over here and this value over here. 1 divided by 1.05. I'm not doing cross multiplication. Be careful. By 1 minus 0.5. I'm just doing left, right, ulta beta. So what we'll get, my dear friends? 1 divided by 1.05 is equal to 0.5. Now let's do cross multiplication. 1 by 0.5 is equal to 1.05 whole power n. What is 1 by 0.5? 2 is equal to 1.05 whole power n. Now the resultant is 2 is equal to 1.05 whole power n. How can you do it? Either you can apply log on both sides and you can solve, or else you can check with the calculator. I'll check with the calculator. 1.05 into 1. I'll go on press equal to till I get 2. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. 1.05 into 1, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. In between 14 and 15 years, you will get 2. By option verification, 1.05 into 1. You go on, press equal to. In between 14 and 15 years, 2 will fall. For 14 years, you will get 1.99 something. For 15, you will get 2. So 2.23 something you will get. So I'll say answer lies in between 14 and 15 years. The simple one. So which option is lying in between 14 and 15 years? Sir, I don't want like this. I want exact answer. I hope you know, apply log on both sides. So n is equal to 14.2 years. If you apply log on both sides also, you will get the answer. Okay. So that's all, my dear friends. We are done with present value of annuity. There is one sum which I want to solve on present value of annuity. That's a previous year question because many of you will get confused here. See this question number 1. This again you'll find in the drive link what I have shared. There you can download this. A loan of 1,02,000 is to be paid back in 2 equal installments. If the rate of interest is 4% per annum compounded annually, then the total interest charged, loan he's telling, loan, we have taken loan, present value of ordinary annuity is given. He's asking how many installments, what is the installment amount? How will you calculate installment? What do you mean by installment? A is missing. You need to calculate the value of A. You remember, my dear friends, I said you A will be equal to present value of ordinary annuity divided by present value annuity factor. So 1,02,000 divided by, how will you calculate present value annuity factor? 1 divided by 1.04 equal to 2 times grand total. 1.8886094. So 1,02,000 divided by 1.886094. You'll get 54,080 rupees. 1,080. Sir, what he is asking? My dear friends, try to understand. You have taken 1,02,000 rupees loan. You are paying 2 installments of 54,080. You are making 2 installments of 54,080. So total how much you are making? 54,080 plus 54,080. You are paying 1,08,160. How much loan did you take? You took loan of 1,02,000, but on the name of installments, how much you paid? 1,08,160. You took 1,02,000 rupees loan, and on the name of installments, you paid 1,08,160. Means, can you tell me how much extra you paid? You paid 6,160 extra. This extra what you paid, 6,160, is itself your interest. Now, whenever he's asking how much interest will be paid, how will you calculate? You'll do sum of annuities minus loan amount. Sum of annuities minus loan amount will simply be interest paid. Okay, this is a previous year question which they have asked in the recent examination, which unfortunately many students couldn't solve, yet it is very simple question. There is nothing much difficulty. Okay, so I hope it's fine, everybody. So let me once revise the whole concept of annuity for you. So what is annuity? 3 keywords. First one, equal payment or receipts made regularly for a limited period of time. If limited period of time is violated, what you call? You simply call it as perpetuity. Annuity made for infinite period is called as perpetuity. Next. How many types of annuity we have? 2 types. Ordinary annuity, annuity due. Ordinary annuity means payments or receipts are made at the end of period. Annuity due means payment or receipts are made at the beginning of period. Next. In ordinary annuity, if you make payment for n periods, you will get interest for n-1 periods. In annuity due, if you make payment for n periods, you will get interest for all n periods. If question is silent, it will be ordinary annuity. If question says beginning now, starting now, today, it is annuity due. If question says at the end of the period, it's ordinary annuity. Now, we have present future value of ordinary annuity. We have future value of annuity due. Future value of ordinary annuity into 1 plus I is future value of annuity due. Future value of ordinary annuity means you are transporting all the money to future. It is future value of ordinary annuity. So what is the formula? A into 1 plus I whole power n minus 1 divided by I. Even sinking fund is also future value of ordinary annuity or annuity due itself. Okay. Next, we have started present value of ordinary annuity and annuity due. You bring everything to present. That is called as present value of ordinary annuity or annuity due. Where you will be using this loan, cash down, borrowing, pension, commutation, if question specifically asks you to calculate present value. Sir, what if question is silent? Future value. Next, present value of annuity due will be ordinary annuity into 1 plus I. Next, present value of ordinary annuity will be equals to A divide A into 1 plus I whole power n minus 1 by I into 1 plus I whole power n. Or else there is one more formula, A divided by I into 1 minus 1 divided by 1 plus I whole power n. Or you are having one more formula, future value of ordinary annuity divided by 1 plus I whole power n. Or my dear friends, you can even use calculator technique. A into present value annuity factor will give you present value ordinary annuity. Present value ordinary annuity divided by present value annuity factor will give you A. How will you calculate present value annuity factor? 1 divided by 1 plus I equal to symbol n times grand total. So these are all the things what we have seen regarding annuity. Yes, sir. So that's all regarding annuity, my dear friends. We have completed the concept of annuity. Now what we have? We have perpetuity, we have leasing, and we have compound annual growth rate technique. So these are the 3-4 concepts what are pending. Simple concepts, nothing much complicated. Let's complete those concepts and let's wipe out this chapter. It's a very simple chapter. Now, next, let's go ahead and let's start with the concept of perpetuity. Now, what is this perpetuity, my dear friends? Perpetuity. Perpetuity means annuity which is made for infinite period of time. That is called as perpetuity. You know this Nobel Prize, right? Nobel Prize is a perpetuity payment. The person who invented atom bomb, he sold the rights. He got a very huge amount of money which he deposited where his institution takes care of that funds, and it generates revenue every year for an infinite period of time. And that revenue what they have generated, some amount will be used for the welfare of the organization, staff salary, everything. Balance amount will be paid as Nobel Prize amount. That's what they have developed. So perpetuity, my dear friends, any annuity which is made for infinite period of time is called as perpetuity. Simple. So how many types of perpetuities you have? You are having 2 types of perpetuity in our syllabus: without growth and with the growth. Sir, what is without growth and what is with the growth? Without growth means the amount what you receive every year will not grow. It will remain fixed. With the growth means amount what you receive every year will go ahead and grow. Let me give you an example. Without growth, say for example, Ramukaka is there. Ramukaka went to a bank and he said, "Hey bank, I want 300 rupees interest every year." Bank said, "Dude, if you want 300 rupees interest, our interest rate is 10%. Then how much you will deposit?" You remember the formula, my dear friends? I said you, interest divided by principal into 100 will give you rate of interest. Here, now I'll do cross multiplication. Interest divided by R into 100 will be equal to principal. Now here, instead of calling it as principal now, I'll call it as perpetuity, because this initial deposit what is there, I'm never going to withdraw it from the bank. That will be there itself. It will be for infinite period of time in the bank itself. The bank will be going on paying me interest every year. Okay. So here in this case, 300 divided by 10 into 100, which is equals to 3000. That's it. That's it is the concept of perpetuity without growth. If I develop the formula will be A divided by I. A will be the amount what you receive every time. I will be the rate of interest. Sir, what about with the growth? With the growth, the formula will be A divided by I minus G, where G is growth rate divided by 100. Sir, why the formula is like this? Why the formula is I divided by I minus G? Don't worry. You will learn it in your CA Inter Financial Management. There your lecturer will even derive this formula. There you will understand the formula more detailedly. But for the time being, just remember perpetuity without growth is A by I. Perpetuity with the growth is A by I minus G. Where this one went? I hope without growth concept is clear. It is just interest rate formula, my dear friends, without growth. There's nothing special there. With the growth, it is A divided by I minus G. Without growth, it is A divided by I. Now, coming to this 2-3 questions, what we are having pending. Just now 31 I have solved. He received a prize money of 300 every year at 10%. So what I said, 300 divided by 10%, which is 3,000. Next, a perpetual annuity of 8,000 made 10% per annum. Perpetual annuity of 8,000 a year. Every year you need to receive 8,000. Rate of interest is 10%. So either you do A divided by I, 8,000 divided by 0.1, or 8,000 directly you divided by 10%. In either of the case, you will get the same answer, 80,000. A divided by I you do, or A divided by R into 100, both are same, my dear friends. Okay. Now, look the second and third one. A person bought a house by paying 45 lakh down payment. He already paid 45 lakh. This fellow already paid 45 lakh and 80,000 at the end of the each year till perpetuity. 80,000 he is paying till end of each year till perpetuity. Rate of interest is 16%. So 45 lakh, what is the present value? So 80,000 divided by 0.16, which is equal to 5 lakh. So 45 lakh plus 5 lakh, 50 lakh. Okay. Try to understand what he's telling in the sum. This person, right now he paid 45 lakhs. After that, every year he's paying 80,000, 80,000, 80,000, 80,000. Every year he's paying till infinite period, if he is alive. So he's asking what is the present value? Simply present value will be 45,000 plus 80,000 divided by 0.16. This is 45,000 plus 5 lakh, which is equal to 50 lakh. Next. If the discounting rate is 14% per annum, then how much a company has to pay to receive 280 growing at 9% annually forever? That is perpetuity with the growth. When with the growth is there, what I said, A divided by I minus G. This formula I can't derive, my dear friends, because you require financial management knowledge. What is I? R by 100, 0.14. Growth, 9 by 100, 0.09. So 280 divided by 0.05. 280 divided by 0.05, which is equal to 5,600. 5,600. So I hope the concept of perpetuity is clear, my dear friends. Yes, sir, the concept of perpetuity is clear. There is nothing much difficulty. Without growth, the formula is A divided by I. Every year, how much you will receive divided by I. With the growth, every year, how much you will receive divided by I minus G. Simple formula. There's nothing much difficulty in this. Okay. Now, before going to CAGR, my dear friends, there is this leasing concept which I want to complete. Okay. Now, first, let me tell you what is this leasing and how will you take a decisions when leasing concept is given. Now, excuse me. Now, in leasing, what happens, my dear friends? You'll be having two options. Option one. And what I'm doing, this leasing sums are from buyer perspective, not from seller perspective. Okay, option 1, option 2. Sir, what is this leasing, sir? First, you please tell that. Okay, sure, I'll tell you. Mr. Ramukaka is there. Okay, Mr. Ramukaka is there. He went to a person who's the owner of a big machinery shop. Okay, so Ramukaka went to owner of a big machinery shop and he asked the owner, dear owner, this is one machinery in your shop which produces very good things. I want one thing, I want you to sell that machinery to me. The owner of the big machinery shop said, Mr. Ramukaka, you do one thing, you want this machinery, right? The worth of this machinery is 1 crore rupees. Immediately Ramukaka got heart attack. He said, 1 crore rupees for this machinery, dude. I can't pay, get lost. Then owner of big machinery shop said, you don't worry. The value of this is 1 crore rupees. Okay. I will give this asset to you. I will give this asset to you. I will give this machinery to you. Every year, you pay me certain installment. Every year, you pay me certain installment amount. No need to pay entire 1 crore at a time. You pay every year, you pay me certain installment amount. That is called as leasing. Now, Ramukaka will sit and think, dude, if I purchase the machine, it will become 1 crore rupees. If I take it on lease, every year I need to pay him 10 lakh rupees at 10% rate. Every year I need to pay him 10 lakhs at 10% for 16 years. Now what happens? Ramukaka will get confused. Dude, he's telling, if I make the entire payment now itself, I need to pay him 1 crore. Or if I take it on lease, taking it on lease means instead of paying a whole amount once, I'll pay him installment every month. Or sorry, every year. If I take it on lease, I need to pay him 10 lakh at 10% for 16 years. Now, obviously, he'll get confused as to what to do. Should I make the whole payment right now? Or should I take it on lease? In this case, my dear friends, what we will do? If you purchase, what is the cost? If you purchase, the cost is 1 crore. If you take the lease, what we will calculate is, we will calculate present value of annuity. Either present value of ordinary annuity you can calculate, or present value of annuity due you can calculate depending upon the sum. Either you can calculate ordinary annuity or either you can calculate annuity due depending upon the sum. But let me solve this sum on the basis of ordinary annuity. I will calculate present value of ordinary annuity. How will I calculate? 1 divided by 1.1. I'll press equal to symbol 16 times. Grand total into 10 lakhs. Let's do this. 1 divided by 1.1. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 15, 16. Grand total into 10 lakhs. So it will be 78,23,708 rupees. If I purchase the machine, I need to pay 1 crore. But if I take it on lease, the net present, the present value of all the things are coming as 78,23,708. So, my dear friends, what do you think? What is better? Purchasing is better, leasing is better. If I purchase, I should pay 1 crore. If I take it on lease, I'll pay only 78 lakhs. So, obviously, I'll tell to Ramukaka, go ahead and take the lease. Sir, why you are calculating present value? The concept is very simple. You have to take the decision today itself. In the present situation itself, you have to take the decision. If you are taking the decision in the present situation itself, so obviously present value only comes. That's the reason I'm calculating present value only. Okay, so point is clear, everybody. So what happens here? Option 1 will be either purchase the machine by making whole payment now, Option 2 will be pay in installments. Now what we will do, sorry, now why this is going up and down, what we will do, we will take option 1, we will compare it with present value of annuity of option 2. Whichever is less, we will go ahead and will accept it. I'll take option 1. I'll calculate present value of annuity of option 2. These two things I'll calculate. Since I am buying, I want less outflow. So whichever gives me less outflow, I'll go ahead and I'll purchase it. That is, I'll go ahead and I exercise that option. Okay. So I hope the point is clear, everybody. Now, so this is all regarding leasing. Let's try to look into the sum. 33, 34, 35. These three questions are something which are based on leasing. Okay. Now, I guess 33 and 35 are based on leasing. And 34, I hope, let's see. What first, let us read the sum. Why to take the decision without reading the sum? Now, first, my dear friends, let us solve question number 33. A company has a proposal of purchasing the machine either by making full payment of 4,000. So, question number 33. Option 1, full payment of 4,000. Now, option 2, that is lease. By leasing a company, by leasing it for 4 years at an annual rate of 1250, if the company can borrow it 14%. N is equal to 4 years. Rate of interest is 14%. A is equal to 1250. N is equal to 4 years. A 1250. R is 14%. Let's compute present value of ordinary annuity. How will you compute, my dear friends? 1 divided by 1.14 equal to symbol 4 times grand total. You will get present value annuity factor into 1250. 1 divided by 1.14, 1, 2, 3, 4 grand total into 1250. How much you got? 3642. Option 1, full payment is 4,000. Leasing is 3642. So what I'll select? Whichever is less. Which is less, my dear friends? 3642 is less. So what is preferable? Leasing is preferable. Okay. So I'll tell leasing is preferable. Next, question number 34. A machine with useful life of 7 years costs 10,000, while another machine with useful life of 5 years costs 8,000. The first machine saves labor expenses of 1,900 annually, and second one saves labor expenses of 2,200 annually. Determine the preferred course of action. This sum I will not solve. This is not a previous year question. This you'll learn it in your CA Inter. In your financial management, there is something called as equivalent annual factor flow sums will be there. There you'll go ahead and you will learn this sums. Okay. Now, let me solve this question number 35. A company can be purchased for 50,000. Machine will contribute 12,000 per year for the next 5 years. Assuming the borrowing cost is 10% per annum, determine which machine should be purchased. Determine whether the machine should be purchased or not. This is not leasing sum, my dear friends. This is NPV sum. However, I'll solve it, and we will solve one question from ICA material. I hope that would be better. Okay. Now, question number 35 is telling a machine can be purchased for 50,000. 35. you can purchase, that is investment is 50,000. Investment is 50,000. Next, what he is telling? Machine will contribute 12,000 per year for the next 5 years. Revenue, it will be 12,000 for year 1, 12,000 for year 2, year 3, year 4, year 5. I hope you remember, my dear friends, how will we compute NPV? Yes, sir, we remember. We will do present value of all returns. Present value of all returns minus investment. Either you can use the calculator trick what I taught you in NPV, or you can solve it normally. 12,000 divided by, what is the rate of interest? 10%. R is 10%. So I is 0.1. 12,000 divided by 0.1 plus 1.1. 12,000 divided by 1.1 whole square plus 12,000 divided by 1.1 whole cube plus 12,000 divided by 1.1 whole power 4 plus 12,000 divided by 1.1 whole power 5 minus investment 50,000. Or you remember, I said you 1 divided by 1.1 into symbol 2 times 12,000 equal to m plus 12,000 equal to symbol 2 times m plus 12,000 equal to symbol 3 times m plus 12,000 equal to symbol 4 times m plus 12,000 equal to symbol 5 times 1, 2, 3, 4, 5 m plus MRC 45,489 minus 50,000 is equal to negative 4,510. You remember what I said? You NPV is negative, will you accept? No, sir. If NPV is negative, we will not accept. So should not be purchased. So simple sum, sir. Simple sum. We will do one thing. We will do a leasing sum from ICA material. So everybody, as we have done one question on leasing, I have downloaded ICA material question. So let's go ahead and solve this question as well. He's telling ABC Limited wants to lease out an asset costing 3,60,000 for the 5-year period. With a fixed rental of 1,05,000 per annum payable annually starting from the end of first year. Suppose the rate of interest is 14% per annum compounded annually, on which money can be invested by the company. Is this agreement favorable to the company? Now, see here, let me explain you. What is the lease out cost? 3,60,000. Option 1 is 3,60,000. Next, option 2. A is 1,05,000. R is 14%. N is equal to 5 years. 5 years. Let's calculate present value of ordinary annuity. How will you calculate? 1 divided by 1.04. Sorry, 1.14. 1 divided by 1.14. 1 divided by 1.14 equal to symbol 1, 2, 3, 4, 5 times grand total into 1,05,000. 1, 2, 3, 4, 5 grand total into 1,05,000. You have 3,60,473. Now what you will tell, sir, option 1 is less, so it's better to go for option 1. No, my dear. The entire concept what I taught you here is on the basis of buyer. Okay. If you see here, he's telling the company wants to lease out. So this is from the seller perspective. Okay. This is from seller perspective. Sir, again for this, I need to remember one more thing. No need. In buyer perspective, what you said, whichever is less. In seller perspective, you will tell whichever is more. From buyer perspective, you tell whichever is less. from seller perspective, you tell whichever is more. He's saying company wants to lease out. Company wants to give an asset on lease. Okay, he's telling company wants to give an asset on lease. So what is the answer, my dear friends? Whichever is more. Option 2 is more. Option 2 is leasing. So that's the reason he's telling leasing is favorable to the company. So let's see, let's start all those things. You did not focus much. These things you learn more detailing in your inter level. Okay, only basics you have here. Just understand the basics. Option 1 you calculate. Option 2 you calculate. If he's from buyer perspective, whichever is less. If you are taking the asset, whichever is less. If you are giving the asset, whichever is more. Simple. Don't complicate. Okay, so that's all regarding leasing. Now, sir, what about this 36th and 37th sum? So 36th and 37th one, they are based on valuation of bond. Now, again, valuation of bond, you will learn detailing in your CA intern in financial management. But what I will do, I'll teach you one sum in 36 and 37. If you are understanding, it's fine. How much ever you are in a position to grab it. Because you don't know how to do valuation of securities, obviously. Okay, some confusion will still be there. It's okay. Confusion is good because that confusion will be cleared in your future. When you go to your intern. Foundation is not the ultimate goal, right? Becoming CA is your ultimate goal. Okay, so there all your confusion gets cleared. Now let me teach you question number 36. An investor intends purchasing the 3-year 1,000 par value bond having a nominal interest rate of 10%. At what price the bond must be purchased if it matures at par and it requires a return of 14%? Now, my dear friends, he's telling he purchases a bond worth ₹1,000 and he will get an interest of 10% every year for 3 years. Means he's purchasing the bond of 1,000. Means, can I say he's getting interest for 3 years? How much interest he is getting? He's getting interest of 10%. So for year 1, year 2, year 3, he will get 100 rupees interest, 100 rupees interest, and 100 rupees interest. Since it is a bond, once maturity is completed, you should pay back the amount for the bond. You will get additional 1,000 rupees after 3 years. Means in year 1, you will get 100, year 2, you will get 100, year 3, you will get 1,100. If he has to purchase now, he's telling now. Now means you'll calculate present value or future value. Obviously, sir, present value. You remember I said you future value divided by 1 plus I whole power n will be present value. So divided by 1.14 whole power 1, 1.14 whole square, 1.14 whole cube. Sir, aram se, how much ever you are unable to take it. No force to absorb everything. Because this is valuation of securities. More detailedly, why you have done, why you have 2 types of interest are there, all those things you will understand later on. Okay, just remember, if any purchase value is given, by chance, if this question comes in the examination, if purchase value is given as 1,000, into first rate of interest you do, you get 100, 100, 100. Since it is a bond, you will get back all the money after 3rd year, 1,000. You will calculate present value, so divided by 1.14, divided by 1.14 whole square, divided by 1.14 whole cube. So 100 divided by 1.14, 87.71, 76.94, 1,100 divided by 1.14, 103, 742.46. Total will be 907.13. So 907.13. Approximately 907.1. Okay. So 37 is also same, my dear friends. If you wish, you can try 37. He's selling a bond with a face value of 5,000, matures in 12 years. The rate of interest is 10% paid annually. What should be the price of bond so as to yield an effective rate of 12%? In denominator, it will be 12. In numerator, it will be 10. 5,000 into 10%, 50 for the next 12 years. Let me write it over here. 5,000. You will get 50 for the next 12 years. 1, 2, 3. What is the question number? Question number 37. 4, 5, 6, 7, 8, 9, 10, 11, 12. Be careful, in 12th year, you will get interest 50 plus 5,000 what you have kept. So you will get 5050 in year 12. 5050. What is the rate of interest is telling? 12%. So divided by 1.12 whole power 1, 1.12 whole square, 1.12 whole cube, 1.12 whole power 4, whole power 5, whole power 6, whole power 7, whole power 8, whole power 9, whole power 10, whole power 11, whole power 12. Let's compute. Yes, sir, let's compute. 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. One, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So total 10 years, bond with the face value of 5,000, matures in 12 years, the nominal rate of it. So what would be the price of bonds? So asked to yield an effective rate equal to 12%. So all I have added, let's check once again. 1 divided by 1.1 to 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Grand total into 50 M plus. Next, 5050. 0.12, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So you will get 1550. So 1550 will be the total of all these things. So simply I'll say answer is none of this, unfortunately. Okay. So I hope the point is clear, my dear friends. However, they are not that important for your examination. When you come to CA Inter, more detailedly you will learn these concepts. So my dear friends, all the concepts are done. Yes, sir, all the concepts are done. Only one concept is pending. CAGR is pending. Let me wind up. There is one previous year question on CAGR which I have taken up. This has been asked in the examination recently. Now, how will you do this CAGR? CAGR means compound annual growth rate. In stock market, what happens? Say, for example, the stock market graph is somewhat like this. It is increasing, it is decreasing, it is increasing, decreasing, increasing, decreasing, increasing, decreasing, increasing, decreasing. Okay. The stock market graph is somewhat like this. I want to average the growth rate. What I will do is that I'll take, this is the starting point, this is the ending point. I'll not take all the fluctuations in between. Without taking all the fluctuations in between, I'll draw a straight line from here to here. If I calculate the rate of this straight line, that is called as CAGR. Okay, that is simply CAGR. So how to do this, all those things, we will take the help of present value formula itself. That is, we'll take principal and accumulated amount formula itself. Let the operating profit of a manufacturer for the 5 years is given below. Then the operating profit of CAGR for year 6 with year 2. Sir, how will you do this? See, my dear friends, it is simple. For year 2, it is given as 100. For year 6, it is given as 157.34. This is your principal. This is your accumulated amount. What is the time gap between year 2 and year 4? Obviously, sir, 4 years. 6 minus 2. He is asking what is the rate of interest. That's a simple thing of CAGR computation. No need to complicate our brains so much other than this. Because these things detailedly you will learn it in your inter and final. So if you see for the second year it is 100, which I'll take it as principal. For sixth year it is 157.34, which is accumulated amount. Time period is 4 years. What is the rate of interest? This will give you this averaged growth rate. Sir, how does it gives you? What is the real logic behind it? Don't worry, you will learn in your near future. You will learn, because all these are finance related concepts. You just have the basics of these so that you can apply them in your inter and final. So we know how to compute accumulated amount is equal to P into 1 plus I whole power n. So 157.34 is equals to 100 into 1.1 whole 1.1 plus I, 1 plus I whole power 4 cross multiplication. 1.5734 is equals to 1.1 1 plus I whole power 4. Take 4 there. 4 under root 1.5734 is equal to 1 plus I. Sir, how will you compute 4 under root? Don't press root symbol 4 times. You should press root symbol only 2 times. 1.5734 press root symbol 2 times. You will get 1.1199 is equal to 1 plus I. Send 1 to the right side. 0.1199 is equal to I. 0.1199 is equal to R by 100. Cross multiplication. What is 0.1199 into 100? Obvious is that it is 11.99. R is equal to 11.99. What is 11.99? Approximately equals to 12%. Okay. So I hope that's fine, my dear friends. So that's all regarding compound interest, annuity, perpetuity, CAGR, NPV, effective rate of interest, simple interest. That's all regarding the time value of money. Good number of questions we have covered. What you must do is that just go ahead and cover all these questions, do all these questions once again. I covered your entire ICA module. There is no questions which I have left in ICA module. All the questions in ICA module are completed. Okay. So that's it, my dear friends. We will meet up in the next chapter.